We go over anything and everything about the algos, the momentum algos that I have programmed on almost 50 items right now, and I generally back test them and optimize them and set them based on a 3-year back test. So every month we do this webinar, and here to answer questions, as well as just describe some things about the service that maybe you didn't know or understand fully. So I'm going to turn off this video of self, and so we can get a full screen view, and we'll be off and running. So this is the algo as applied. I just call it my AMA algo for short. And if I have a 2.0 on there, that means that it uses the DSI, the Daily Sentiment Index, which is the current percentage of bulls among retail traders. I use that as a filter on anything that says 2.0 on it. Otherwise, on items like ETFs, there's no DSI data available on ETFs. DSI really is only available on futures contracts. So there's a futures contract that represents lots of things, but not everything that's tradable, not everything that's on my list of things that I cover. So I thought I'd just very quickly describe what the AMA algo is and what it does. And we'll just use this crude oil here as an example. There's just a few indicators on the chart, and I've described this in previous sessions as well, so I don't want to spend too much time on it, so this is a little bit of a review. But one indicator is this moving average that's running constantly through above and below and through the middle of price candles, and that's called the AMA, or adaptive moving average. And there's 3 settings that you can use associated with the adaptive moving average. And just out of simplicity, you can find more information about the adaptive moving average online by Googling it, but there's kind of a long and a short period for the moving average, and then a number of days that it considers as it moves along. And what the adaptive moving average does is it is able to kind of stay close to price. It adapts to the volatility, and it can stay relatively close to price depending on how tight you set those settings. So on crude oil, it's got it set for 8, 3, and 30. Well, if I set this for 12, 3, and 30, we'll see in a second here that what that does is it slows it down, it smooths it out quite a bit. And so I've got my algo back testable so that I can back test. I'll put it back to the original 8, so that I can back test all 3 of those parameters that are associated with the adaptive moving average. And let's go to edit the strategy. And we can see that there's number of bars, fast and slow. So my description from before was incorrect based on those parameters. But anyway, those are the 3 parameters that I'm inside the AMA. There's some other math going on in the background, but I do know that the guy that developed the adaptive moving average is the same fellow that wrote a book called Trading Systems and Methods. It's Perry Kaufman. Perry Kaufman, a famous technician and early programmer of algorithmic trading systems. So there's those three settings there, and I can backtest on all of them, but I never backtest on the 30 because he says to just keep that on 30. All right. And then also I have a kind of a custom indicator down here that I call the Walter Bressert. And what the Walter Bressert is a smoothed RSI. And you can create, if your platform is capable of this, you can create the Walter Bressert indicator by taking a standard RSI with the standard default settings, create a 3-period moving average of it, and then create a 3-period moving average of the 3-period moving average you just made. And you end up with something that is kind of like an RSI, but it smooths it considerably. And Walter Bressert originally called that the RSI 3M3. And then he suggested having a moving average of that indicator and looking for crossovers to create signals, and that's what I've done. So I've recreated his RSI 3M3, and then I've put a moving average of it, and the RSI 3M3 never changes. It's the same on every item, but the moving average of it, I've got it back testable as well. In this case, it back tests best using a 13-period simple moving average of the Walter Bressert. And so what the algo does, and so there was two things required for this buy signal on crude oil that happened today at the close, August 13 of 2019. And that is that the Walter Bressert had to be on a positive or green crossover. So you can see it, the Walter Bressert crossed up over its moving average back here, couple bars ago, looks like. One actually yesterday created a crossover. But then the adaptive moving average, and this it's the adaptive moving average in this case back tests best at 8, a 3, and a 30. It has to be sloping to the upside. In other words, it has to close above what it closed the day before in order for it to be green. And so it usually is a little slower than the Walter Bressert. And so the Walter Bressert almost always crosses over first. Then as soon as you get some upslope to the adaptive moving average, you have those two in agreement, and that's where you get your buy signal. So it doesn't try to catch bottoms. What it does is it tries to get in during the strongest middle portion of a wave. So it's a little slow to get in, and by doing a lot of back testing, I tried to get it to and I can get it to react much quicker by trying some different settings on the AMA and the Walter Bressert. For instance, instead of a 13 EMA on the Walter Bressert, I could set that at a 2. All of a sudden, it's very, very fast. Now, these green, I would have to reprogram where the green and the reds come in, but it first crossed over way back here, real early. But the fact is, and then I could have the adaptive moving average here react much, much quicker as well. by setting those settings much lower. But I back test for that every time. Every time I do a back test, I back test. I'm looking for the most optimum entry that is able to produce profits over the long haul. And as a general rule, it does better if it waits until it has what it usually amounts to a somewhat of a trend line break. So in this case, it did peak just slightly above a trend line moving across these last two tops today, and it moved up enough that it produced a buy signal. So it's slightly, this is usually where it comes in at a kind of a trend line break. And then the entry is one thing, but the exit is, and how it handles the trade after that is really even more important. And so for it to exit, what I found in back testing is that because the Walter Bressert is quicker, it's a quicker system, and it usually will get a crossover faster than the AMA after it changes back to a red color like it did right here. It was green, it was sloping up, then it was red, sloping down. That is on the slow side, and so the algo could give up quite a bit of profit before that started sloping back to the downside. And so for entries, I look for agreement of two items, but for exits, I look to exit at the quicker item to exit, so in order to lock in profit, and that would be the Walter Bressert. And there's two things I do with the Walter Bressert. One, if it backtests best without using a trailing stop, then I will simply have it exit when you get the next crossover. In other words, one of these red blocks. But I also have placed an additional indicator on here that I do use. Change this around there, and that is, sometimes I check to see if it would be better to exit even faster than the crossover. And that little arrow right there came in one bar earlier than this bar. And that arrow comes in on the first bar where the Walter Bressert indicator itself, this heavier line, starts sloping. It reverses on its slope. So at this bar right here was the first time that the Walter Bressert all of a sudden was sloping to the downside. And so I back tested to see if a trailing stop would be advantageous upon the appearance of those arrows. And I back test not only would a trailing stop be better, but the size of the trailing stop. And I also back test on the size of the initial stop. All of those things are optimized on a 3-year back test on everything. And so there's a lot of stuff going on in the algo. And then there's one, and so what you end up doing, like on this buy signal right here, you had the Walter Bressert on a green crossover already. Then all of a sudden the adaptive moving average started sloping to the upside. So at the close of this candle, it said get long at the opening of the next daily candle. So it gets long there. And it moved up until it got one of these red blocks. And that red block was basically a crossover of the Walter Bressert. And you can see that came in on the very top candle. At the point that candle closed, nobody knew that was definitely going to be the top tick candle of this up move, but it ended up being, and so that it's pretty common for that block to show up real close to some significant tops here, here, and same thing on some bottoms here. Not as accurate here. And right here that was an exit of a short position. Then today we got an entry to have a long position. So I've got these two indicators working together for agreement on entries and then the fastest exit possible. And then there's one other thing that I have the Algo do if it is an Algo 2.0, and that is that I have it look at the daily sentiment index to see if, because the theory behind the daily sentiment index is if retail traders are overly bullish, they generally will chase a trend lower, and just about the time you get a trend change, they're at their very most, a trend change from down to up, they are at their very most bearish. So the DSI was only 14 right here, which meant that only 14% of retail traders were bullish at the end of this candle. And then it also looks for extremes on the high side as well. For instance, right here on if you look right up here, this date right up in here, as I move this crosshair around, that was on April 23rd. On April 23rd, the DSI was an 88. So so what I do with this DSI indicator, which if it is available, if it's a futures contract, then it'll have it on it. If it's not a futures contract and it's a ETF, I have created something called a kind of a synthetic version of it that kind of acts like it, and doesn't mimic it exactly, but at least gives you an idea where retail traders are likely positioned in the absence of having DSI on that item. And so notice that when the retail traders are extremely bullish, you get one of these pink zones down here. And when they're extremely bearish, you get one of these green zones. And matter of fact, I need to go to the settings. Green zone. Yeah. And I can back test to find out what the thresholds are at the high end and the low end that are most advantageous over the last 3 years. And what I found in my back testing here was that if, over the last 3 years, if retail traders, believe it or not, were below 35, and let me bring, is that right? No, 6, hang on, 6 and 81. Let me change this graphic here. It's 6. I'm going to go to the actual, okay, it might be 35. I'm going to back test that one more time. I'm going to run a back test right now to see if it's most advantageous. Yeah, and you can see it brings in more money if you don't short it, if the DSI is below 35. Wow. So, so I need to change one thing on this. Let's see, did I change something? 35. Save it. It says 35 there, but down here, this needs, yeah, that's right. Yeah, the only thing that's 81, this needs to be changed to 35. Okay. And what that did is it changed this line to green when it's below 35, and that, this was already showing as red when it was above 81. So if the DSI is below 35, according to backtesting, it isn't even worth shorting it. It doesn't backtest while shorting it, so it's using it as a filter. And on the other hand, if the DSI is above 81, it's suggesting not taking in long signals. And you can see that when you get one of these pink zones down here, you get a red box, thin box up here. And that means if you get a long signal inside of a thin red box, that signal is skipped. It is skipped. Now, in the case of this signal right here, that probably would have been profitable, but in the case of this signal, it would not have been. Well, let's look down here on, and you can see that during this green zone down here, where the DSI was below 35, there were no buy signals that appeared exactly in there. By the time we got a buy signal, the DSI was barely up above 35 already, and so it could take long signals. But had a green triangle appeared underneath price pointing upward inside of this green box, it would have ignored that signal. So that's basically how the algo works. And so when we look at the back-tested settings over the last 3 years, and I almost always will back-test it on whatever brings in the most profit. Occasionally, though, I might, if it's real close in the items that bring in the most profit, I might also favor something that almost brings in as much profit, but it has a better winning percentage or is able to use a smaller stop. So in this case, notice it's recommending a $1,900 stop. Now, obviously, someone has to have a pretty good size account in order to trade with a $1,900 stop. Trade one contract at a time on the CL contract and putting in the initial stop in 1900. But over a 3-year period, what we found, and this, I did a quick back test, and it shows you that the $1,900 stop brought in $62,000. And as the ranking of the stop size, it really went up from there. Using a larger stop still brought in pretty good size profits, but using a smaller stop cut it way back. Like if you use the $800 stop, it's only $27,000 profit. It cuts the profits in by more than half. And so, finding out, matching the stop size to the organic volatility of an item is extremely important. And you might say, well, I can't afford to risk $1,900 on every trade. And I'll show you what you can do about that in a minute. But in this particular instance, I just wanted to show you, this is a daily chart of crude oil. And I made a couple of measuring sticks and put them on the screen here so you can see how large a $1,900 stop is. And you can see that it's smaller than the daily range of today's candle. Today's candle on crude oil on one contract alone, just trading one contract, it had a swing from the lowest point in the day to the highest point of the day of 326 ticks, or $3,260. Okay. And so this, all of a sudden, the $1,900 stop doesn't seem that huge when you compare it with the size of some of these candles. Now you're seeing, I've got my streaming on right now, and it's showing you exactly where this stop is. where the stop is. So this is suggested going along at the open of today's new candle. In the futures market, that new candle just opened, and it opened at $56.74. And it's saying put the stop at 54.84. So but when you get your nightly report, you don't get this stop level shown to you because the streaming is off. Streaming is off when we take the screenshots. And the reason the streaming is off is because it can throw off, especially on the sentiment charts that we provide every night to premium plan members. It can throw off, like right now. That I will guarantee you that the commercials percent of open interest is not going to look like that in tonight's candle or in tonight's screenshot edition, because the updating of that Trade Navigator gets and generally doesn't get to us until about this time every night hasn't come in yet, and we have to wait for that daily close of some of the sentiment stuff, including the DSI and other things, in order for these indicators to look correct. So for instance, if I turned off the streaming all of a sudden, and you'll see that the commercials percent of open interest, if the streaming is turned off, at the end of the day yesterday, it showed that the commercials were heavily long crude oil, and on the 6-month look back, they're heavily long. So you also get this every night on 20 plus items on the premium plan, you get a screenshot of the crude oil chart and a screenshot of the sentiment chart. And that's on crude oil, and you get those two charts on everything that has sentiment available to it, which is basically the futures contracts. If it's an ETF, I'm instead of a sentiment screenshot like this, I put a kind of a rough indicator that I call a synthetic retail sentiment that I've come up with that kind of shows you where retail likely is positioned, and you get to see that on the ETFs, because that's just the best we can do. We know the daily sentiment index is not published on that. So I do see a misspelling here. I'm going to change that really quick. Okay. So you can see when I turn the streaming off, you get a much better picture. And if the streaming is on during the screenshot, you don't get a good picture. So here's what this screenshot is going to look like tonight on crude oil. Oh, wait a minute. Well, it hasn't done the nightly close, so it doesn't even have the candle on it yet. I'm turning the streaming back on. You'll see it. It'll look like this with a buy signal, but this candle will not have started to form yet. So you will have to figure out where to put your stop. It won't show you that yet. So how do you figure that out? Well, what I would do is what I've done right here is keep something like this on your charts all the time that gives you, if my stop is $1,900, I know that line right there is going to be, exactly the size of my stop. Now, it just so happens on crude oil, it's fairly high, fairly easy to figure out. Every $1 per barrel of movement in crude oil is worth $1,000 on a single CL contract. So that's each 1 point is worth $1,000. The points are divided into 100 ticks. So every penny of movement of the CL contract is considered 1 tick. So if 100 ticks is worth $1,000, how much is 1 tick worth? Well, it's worth $10. So every tick, every penny which is the smallest movement in the crude oil contract. Every time it moves a penny, then if someone is in on this trade, either long or short, or with one CL contract, it will move in value $10. So a $1,900 stop is how many ticks? 190. So, and in crude oil, it's pretty easy to figure out. That's $1.90 per barrel of oil. And that is the size of the stop that is recommended by back testing over the last 3 years in optimization. One of the reasons I'm going over crude oil so thoroughly here, and by the way, you can also figure this candle right here opened. I'm going to look right up here to the opening price when I hold the candle over that, and it opened at 56.74. So all you have to do is bring up your trusty calculator on crude oil. And I'm trying to move it over there, 56.74 minus $1.90, because I know that's the size of the stop. 54.84 should be the size of where the stop is set, and that's exactly where it's set. Why would I talk about crude oil so much today? Well, because every month in tonight's edition of the nightly reports, and I'm putting it in the nightly reports for premium plan people, I'm putting it in the crypto reports for the crypto reports people, and I'm letting the screenshots and the webinar people all look at this spreadsheet. And we generate this once a month. And get this kind of optimized here, where I can show you all of it at once if I can. There we go. And so in tonight's edition of the nightly Algo reports and the crypto reports, which everybody gets, it's a paying customer of mine, you get this spreadsheet, and you're going to get it in Excel format. So when you get it in Excel format, you can download it. And when you download it, you can start working with it and doing your own sorting. The reason I am showing crude oil is like this is the number of trades that the algo has based on current settings would have traded over the last 3 years. The first item is number 4. The last item is number 50. So there's 51. So there's now 47 items on this list that I've programmed and back tested and optimized the algo for. Well, let's say we want to look at return on investment. What's bringing in, excuse me, what's bringing in the most profit, most dollars profit based on the account size required. Now, the account size required, the back test figures that out for you based on assuming that you start with an account and it never goes so low that you get margin called during the entire back test. Even in the case of Bitcoin had to suffer through 11 consecutive losses based on the current algo settings at some point over the last 3 years, which is definitely not optimum. But it still turned a $14,000 account into $135,000 account plus the original 14. So that account would have turned into a $150,000 account approximately in 3 years trading Bitcoin. But the thing you got to realize about Bitcoin is every tick is worth a ton, and it's highly volatile. And these moves in Bitcoin are worth huge amounts, but you really, I think, they won't even let you trade a single contract of that unless you have, I think, an account size of $25,000, possibly more. So you might check with your broker on that. But I would say crude oil is, and the other thing about that Bitcoin, at least if you're a U.S. citizen, that's the only real way to short Bitcoin right now. And you can go long, both or short, either one. It's a futures contract. But at least in these early days of Bitcoin, as far as being tradable in the U.S. by regulated futures, and that's CBOE there, they have made it really to where your average Joe can't trade it. It's too volatile. It moves too much. You got to have big account size to trade it. So your average Joe or your beginning Joe that's trying to trade in the futures market really has no business trading Bitcoin, not with like a $5,000 or $10,000 account. Whereas crude oil is number 2 this month, and it brought in a 468% return 3-year gain, ROI. So the account size required there is 13,000, and it brought in $62,000 of profit on top of that in 3 years if it was traded using current settings during that entire time. And notice the winning percentage is quite excellent on the crude oil item. As a matter of fact, if in crude oil is third in winning percentage of all the 48 or 47 items that it is in third place. That algo wins about 60% of the time. Now you might say, well, what good is a 60% winning percentage? Well, it's worth a lot because the average winner is $2,431, and the average loser only $1,168, and this is the case virtually across the board on the way I've designed this algo. I've looked at a lot of different algos, and I wanted to come up with something that would produce some tremendous return on investment. In other words, really put up some big numbers of gains. And in order to do that, it has to be able to, if it happens to catch one of these trades correctly, like this one right here, this is a short trade on crude oil. And yeah, it took 1, 2, 3, 4, 5 days after sideways jump before it finally broke down. But that trade right there, these big green boxes, those are winning trades. It's the dark red boxes that are the losing trades. So that trade right there was a $4,000 winner. And you'll see when you look back on the way the algo trades, the green boxes are always bigger than the red boxes because they theoretically have no limit. They'll continue to stick with a trade until there's a loss of momentum. And so once in a while you get just an incredible winner. There was one earlier this year on Bitcoin. But once again, moving back to the spreadsheet, we can see that crude oil, it has a good winning percentage. The average winner is well in excess of twice the average loser. It trades quite a bit. It doesn't require a tremendously huge account size. And here's the really cool thing about it that I think a lot of people would like is that it, despite, I'm going to sort it by return on investment again, of all the top gainers on return on investment, it had the least number of consecutive losses during the back test. There was one point where it only lost 4 times. 4 times is the maximum number of times that it lost in a row during the back test, whereas at one point, apparently, or possibly more than one point, it had 7 winners in a row. So that's a nice ratio. It did have to, during these 4 losses, probably, it did have to suffer through a $7,790 drawdown, and that's why it needed that account size, a pretty healthy account size, in order to survive the drawdown, not get margin called, keep going. It used a $1,900 stop, and it doesn't backtest well using a trailing stop. Let me show you that as a. I'll show you what I do on the trailing stop. Is I always backtest first without a trailing stop. Without a trailing stop. And because I want it to have good, I want the algo to have good settings, good bones, and I don't want it to count on a trailing stop in order to be a profitable algo. But then once I get the best settings, and by the way, I'll take that off of there. Once I have the best settings, and I'm going to run a quick back test on this, except, hang on, got to uncheck something. Oh, yeah. So this over 3-year period of time brought in $62,000 worth of profit. Notice that that is exactly the amount that I transfer over. I transfer the statistics over to these little boxes so you can see how I backtest it. There's the equity, what's called the equity curve over the past 3 years. And notice that the drawdown periods, because it only suffered 4 losses in a row one time, and it at one point had 7 wins in a row, that trying to pick the ones that don't have long winning streaks seems to bring a much more consistent equity curve. That's the size of the account as it's trading throughout the last 3 years as it grew. And so that brought in $62,010. And if I add a trailing stop to it and backtest that, and I wanted to look at can I get a better return than $62,000 by bringing a trailing stop in? And the answer is no. I never can make it nearly as good, and it uses these incredibly huge trailing stops. So I generally don't like to have it add a trailing stop unless the trailing stop is about the same size as the original stop or smaller. And remember, on my algo, it doesn't start the trade with a trailing stop. It waits until it sees the very earliest sign of a loss of momentum, which is the sloping down of this Walter Bressert, and then it I have it look at starting and trailing stop right then and there. And on some items, it can backtest very well. And I got to tell you, recently we had an amazing trading day with the system, and a lot of trailing stops were hit in profit. That was happened just a few days ago. So that's how I backtest and do all the settings and establish where it puts its signals. I use a 3-year backtest. There's one item that is real interesting. It's been very interesting recently, and that is gold on the algo. And because I use a 3-year backtest, for those of you that are real familiar with the way gold's been moving, there was a huge, huge move to the upside during the first half of 2016. So this is about the beginning of 2016 here, and it had that giant move up through about July of 2016. And then for the next 2.5 years, it chopped sideways until late May of this year, when it finally broke out and moved up above the high that it had back in 2016. because since I'm using a 3-year back test, it's only looking back now through about July, August. So it only looks about to this top right here on its back testing when it figures out what thresholds to use on the DSI, for instance. And I noticed that recently on gold, it had refused to take some long signals that would have been profitable, except they were being filtered out because the DSI was so high. The retail sentiment on gold recently has been nosebleed levels, and it's kind of been staying there. Like it first reached up into the 90s back here in late June. It got back into the 90s a little bit here in the middle of July. And almost during the entire month of August, it's been above 90, and it was recently as high as 97. And so on a 3-year back test, when we look back on gold, it's now ignoring that big ramp up at the beginning of first half of 2016. It's not in the back tested period because I generally universally use 3 years. And when I use the last 3 years of back testing, it suggests not getting long gold if the DSI is above 87. So if there's over 87% of retail traders that are currently bullish, it doesn't like to take a long trade because retail traders are notoriously wrong en masse at major turns. That's the reason we look at retail sentiment, is for clues that we're near top, because they're chasers. Retail traders are chasers. Whereas on the bearish side, it suggested only refusing to take short signals on gold if it were below a 6 on DSI. So that is a super low number, and it's very rare that gold DSI would get down below 6. But here recently, it's been staying above 87. So when it's above 87, and that's that threshold right there, that red line, you get these red boxes. And if it's inside a little red thin box, it refuses to take a long signal. Well, it would have had a long signal come in on July 30 right there. And that would have been probably a good signal if it wouldn't have gotten stopped out here, which it might have. I haven't measured it. I'm going to measure that. That stop would have been a $3,000 stop. It would have gotten stopped out. It didn't take it. It would have gotten stopped out on 8/1, August 1, because the stop is a $2,300 stop, and that dip from the entry point to the bottom tick was worth more than 2,300. It was worth 3,460. So it would have been stopped out anyway. But this skipping of signals when the DSI is very high caused me to look at this algo and go, okay, well, right now I've got it from basically 8/1 of 2016 through 7/31 of 2019. So that's a 3-year back test. All right. What if I start and notice when we back test it, it won't take a long signal if it's above 87. And I wanted it to look back at that big ramp up in the first half of 2016 to see if that number would have been different if I included that in the back test, that period. So I'm going to go back 4 years on the back test. And I'm going to run, by the way, 3-year back test brought in 42,235 of profit. Now I've set for 4 years, and I'm just going to use the same settings, but I'm going to see if using a different DSI would have made any difference. And it suggests that these top four numbers right here are the same, and it would make 57,000. So yeah, when you include that additional year, yes, it makes some additional money. But, and I always take the highest number, 88. That would have changed this only from an 87 to an 88, so it'll almost make no difference. It makes no difference. And probably the reason why that it doesn't make any difference, 87 or 88, is because it would have gotten long in this same spot here, and it would have gotten stopped dead anyway. So once in a while, you have this really rare situation where DSI can stay elevated, super elevated for an extended period of time, and the market can keep going up. But it's rare, very rare, and we really didn't have that. Let me make sure I've got all these settings the same, and I haven't changed anything. 11,330, 6 and 87, 88. Thresholds. Yeah, 6 and 8. Oh, yeah, hang on, 8, 6. 2,300. Okay, let me run that back test real quick. Whoops. Going to stop that and make sure that it comes out with the same number. 42,235. Now, oh, I got to change the dates. Got to change the dates back. Got to be careful to change the dates back and get everything back the way it was here. Otherwise, I'll save it as the wrong thing. And I'm going to run that back test, and it says, yes, an 88 is the proper number. I'm going to use that value. And then I'm going to run it, and that should come up with 42,235, which is the same numbers in the box. So I've got to set back to normal. There's the equity curve on gold, still pretty good. It was a little choppy last year, but still pretty good. And so far this year, excellent. Relatively smooth over the last 3 years on gold. So I'm going to save that, close it. What else did I want to show you? Showed you, at my website, Elliott Way Plus, I showed you earlier how to set the stop. I showed you a quick little rundown of how to set the stop. Go to Elliott Way Plus, go to resources, go to guides, and there's something you can all find there, setting protective stops, and it shows you how to figure protective stops, not only on futures contracts, but also on ETFs. ETFs, both of them. Shows you how to do that. And let's see here. Oh, that reminds me of something I forgot to show you at the beginning of the webinar, and that is my disclaimer. I'm going to show it to you now. Don't forget that my disclaimer is at my site. It's there all the time. It's you go to the bottom of any page of my website, click on Terms of Service Disclaimer. It's there. And if I were to summarize it in one sentence, it would be there's risk of loss in all trading. And when we're talking about algos, it's also important to realize that past results is no guarantee of futures results. It's all, what we're dealing with when we're dealing with algos is a game of probability, which quite frankly is identically the same game that we play as traders, no matter what method we use. Elliott wave analysis is a game of probability. Trading Hurst cycles is basically trying to put the odds in your favor when you place trades, and it's the same thing with algorithmic trading. So don't forget to examine the the sortable spreadsheet, I think you can find some really good information there. If you have a smaller account and you can't stand the idea of placing $2,000 bets every time you place a trade, then what you do is you look for, on the sortable spreadsheet, the account size required, smallest to largest. And you can see that there's a couple of pretty good tradable items down there you can do with a small futures account. Like the Dow Jones Industrial Average new MYM contract is called a micro. It's a new micro E-mini. There's 3 of those. There's the MYM, the M2K, and the MES. And of those 3, it looks like to me the one that would be the easiest to deal with because it has a little better winning percentage. The return on investment is as good as any of them. And it didn't have quite as many consecutive losers during its back test. The maximum drawdown was on the low side, and the initial fixed stop is $140 stop. So that's something you can trade with an account size as little as $1,400, starting at $1,400, one contract at a time. Every bet is a $140 bet. And at some point, and during the proceedings, it may ask you to change to a trailing stop, $180. So as far as back testing goes, I think that one has the cleanest settings and would be suitable for someone with a smaller account. Other items that do well with smaller accounts would be on down the list here. My favorite is the US dollar. On the US dollar, the account size required is $5,436. Has a 332% return on investment over 3 years. So it turned $5,400 account into, after $18,000 of additional profit, into about a $23,000 account in 3 years. Just has a 50% winning percentage, but the winners on average have been $937. Losers $391. Isn't it amazing that the average loser is $391 and you're using a $1,400 stop on that item? How can that be? Well, the reason is because once it gets into a trade, let's say it gets into a lousy trade. Here's a long trade right here, and it just inches its way up for a while. And it doesn't wait until it gets stopped out. It waits until it has a sign of a loss of momentum. And even on this short trade right here, it's a short trade. It's still kind of goobered around down low, and then it showed a loss of momentum, and it got out with a far smaller loss than the original initial stop. And that's usually when you get stopped out. It's not because it hits that big stop that's set. It's because it closes out the trade because there's of lack of momentum in your favor, or it may hit a trailing stop, slightly in profit or slightly in loss, and those are more likely the times the way you would get taken out of a trade with this algo, not necessarily the full size of the original stop. One last word I would say is that these algos, I think it's real effective to use them in conjunction with my regular Hurst and cycles work. So for those of you that subscribe to my screenshot service or to my pro plan that includes the webinar, but maybe you don't get these signals, remember that it was late in May that Hurst was suggesting that gold was going to move to the upside. There was a 40-week cycle trough due somewhere there in May, and it got all the way late in May. It was unable to make a new low. The 40-week cycle trough was, that's Hurst language, was overdue, and everything looked bullish. And on a Wednesday, I sent, at the close, I sent out it was on this day right there. I sent out screenshots that suggested that gold was going to start moving up strongly from there. That was on Wednesday, May 22. And at that juncture, May 22 on the Algo was right here, and it was already in a long trade. Now, it suggested closing that trade out 2 days later, but then it suggested getting back in at the close on May 30, and my analysis was still very bullish from there. And so you can use my analysis in conjunction with these signals, and obviously there was a beautiful move up in gold right there, and it really worked well. And so many of my subscribers will use, that our premium plan subscribers will look at my Hearst and Elliott wave, see if it agrees with the signal, and then that gives them some extra confidence. And in my opinion, it gives them an extra chance of making profit and avoiding the occasional, dumb trade, wrong way trade. If we just saw a 40-week cycle trough down here in May, we're likely to be moving up for a number of weeks out of there. And so any kind of fake out signals, like sell signals that might occur in there, best avoided right after a large cycle trough. And also, I was on my count expecting at least a wave 5 of an expanding diagonal to the upside, and possibly a wave 3 to the upside. So everything was looking real bullish. So there's no reason to mess with any short trades like this one in the middle of May at that time. So I think that's everything I wanted to cover this week. Does anybody have any questions? Does anybody have any questions that they'd like to present to me before we close out the monthly webinar? I see we ended up with quite a few more people this time, which is great to see. Maybe I'll remember this 5:30 p.m. Central Time, as that's probably the most I've seen in the room live on this webinar. I send the recording out to all of my paying subscribers on all plan levels, so they can kind of see how the premium plan works. And all of this, it really translates over to, I'm using the same algo, the same backtesting system, same way of choosing how I've got the indicator set, and that all on a 3-year backtesting on all of the cryptos. And I think on the cryptos, it's especially valuable to look at what I'm expecting on the Hearst and Elliott wave, and maybe consider that this was a real good time to get out of Bitcoin. It suggested getting out of a long position on August 8. And August 8 on my Elliott wave and Hearst roadmap was right there, and was expecting a move down next based on Hearst and Elliott. So those signals have been working pretty well together with my Hearst and Elliott wave on Bitcoin as well. I don't see any questions, so thank you so much for joining me. I'll send this recording out to you here shortly. Appreciate your being a subscriber. And if you have any questions about anything I do, please send me an email at sid@elliottwaveplus.com. Have a great rest of the week in the markets, and we'll see you soon.